Welcome to the deep dive. You know how sometimes you look at a fancy car and there's maybe a little sticker on the window, some sort of seal of inspection or approval?
Mm-hmm.
Well, imagine that sticker, but for a company's financial health. Today, we're pulling back the curtain on that sticker,
Mm-hmm.
the auditor's report.
Yeah,
It's what tells you if a company's financial statements are, truly reliable.
exactly. And it's far more than just a rubber stamp or a signature. This deep dive, it'll empower you to understand the critical nuances of an auditor's opinion.
Okay.
Everything from the all-clear signal to subtle warnings and even outright red flags.
Right.
By the end of this, you'll be able to interpret these reports like a pro, really understanding the credibility of the financial information you consume.
Okay, let's unpack this. Our mission today is to make these often dense documents crystal clear for you. So let's start with the absolute basics. What exactly is an audit's fundamental purpose, and why is an independent auditor so crucial, for building financial trust?
Well, at its core, an audit's purpose is really to lend credibility to financial statements.
Credibility, okay?
Think about it. A company's own management prepares these statements. Now, if there's no outside check, how do you, as an investor or maybe a creditor, know they're not just telling you what you want to hear?
Good point.
So an independent auditor steps in to provide a professional opinion, an opinion on whether those financial statements are presented fairly in all important respects. According to a specific rule book, like, say, U.S. GAAP, it's their job to vouch for the numbers, essentially.
So they're not just numbers checkers. They're almost like financial referees, making sure everyone plays by the rules.
That's a great analogy. Yeah.
It sounds like this isn't a passive job at all.
Yeah.
What are some of the active responsibilities auditors have that might, surprise someone who just thinks they checked the books?
Oh, it's definitely active. Auditors must always maintain what we call professional skepticism.
Skepticism, okay.
Imagine you're told the sky is green. You wouldn't just agree, would you? You'd look up and check.
Right.
An auditor does the same. They don't assume management is lying, but they also don't just take their word for it. They approach everything with a show me the evidence mindset, constantly questioning, digging deeper, even when things look perfectly fine on the surface.
So always questioning.
And they have to comply with strict ethical requirements, especially independence, not just in how they act, but how they appear to others.
Appearance matters too.
Interesting.
Absolutely. Plus, professional judgment is exercised throughout the audit, and of course the big one.
Mm-hmm.
They have to gather enough appropriate audit evidence to back up their opinion.
But even with all that rigor, there are still inherent limitations to an audit, right? It's not about absolute certainty, is it?
That's a critical point. Exactly.
Explicit.
It's about reasonable assurance, which is a very high level of assurance, but like you said, not absolute.
Why not?
Well, a few reasons. Financial reporting itself isn't a perfect science. It involves judgment, estimates. So there's always a bit of, let's say, professional guesswork involved.
Also, fraud can be incredibly cleverly concealed, making it difficult to detect, and auditors don't have, the legal powers of an investigator.
Right, they're not detectives.
And finally, there are practical limits. Limits on audit procedures, balancing the cost of an audit with the need for timely financial reporting. You just can't audit every single transaction.
Makes sense. Use testing and other smart means.
Precisely.
So when everything is perfect, relatively speaking, when the financial statements are as clean as a whistle, that's what's known as an unmodified opinion for private companies or an unqualified opinion for public ones.
That's right.
But what does that gold standard truly mean beyond just a pass grade?
Well, an unmodified opinion isn't just a rubber stamp. It's like the financial equivalent of a doctor saying, your vital signs are perfect, everything looks healthy.
Okay, a clean bill of health.
Exactly. For you, the investor or user, it's the baseline confidence booster. It signals that the numbers you're seeing are reliable enough to base your decisions on. It means the auditor has concluded that the financial statements present fairly in all material respects the company's financial position, results of operations, cash flows, all in conformity with the applicable financial reporting framework, like U.S. GAAP.
That's what companies want.
That's the goal.
Yes. And these standard reports, they aren't just one big blob of text, are they?
Yeah.
They have specific sections that are essential to understanding them.
They absolutely do. You'll find an opinion section right up front, which clearly states the auditor's conclusion.
The bottom line.
Pretty much. Then there's the basis for opinion section. This explains that the audit was conducted according to generally accepted auditing standards, or GAS.
GAS, okay.
And that the auditor is independent and obtains sufficient evidence. Crucially, there are also sections detailing management's responsibilities. They prepare the statements, and auditors' responsibilities. They audit them.
That brings up a critical distinction I want to highlight because I think people often confuse them.
Yeah.
GAS versus the financial reporting framework.
Mm.
Can you clarify how they differ?
Yeah, that's a really common point of confusion. Think of it this way. GS, generally accepted auditing standards, dictates how the audit itself is performed.
How it's done.
Right. It's the auditor's instruction manual. It tells them to say, physically observe inventory counts or confirm bank balances, how to gather the evidence.
Okay.
The financial reporting framework, on the other hand, like GAAP or IFRS, is the rulebook that dictates how the company records its transactions and prepares its financial statements.
So what gets reported and how?
Exactly. For example, U.S. GAAP tells a company that land shouldn't be depreciated or how to account for a complex lease. So GS is the how to audit guide, and the framework is the how to prepare financial statements guide.
Got it. Both vital, but different jobs.
Precisely. Now, what happens when that clean opinion isn't possible? This is where we get into the world of modified reports.
Okay.
And it typically happens for one of two main reasons. Either there's a problem within the financial statements themselves, what we call a material misstatement.
A mistake, basically.
A significant mistake, yes. Or the auditor couldn't get enough evidence to form a clean opinion. We call that a scope limitation.
They couldn't check something important.
That's the idea.
And how do auditors decide what type of modified opinion to issue? I heard it really comes down to two key terms: materiality and pervasiveness. For our listeners, how do we kind of intuitively grasp these?
Great question. Materiality is basically asking, does it matter?
Matter to who?
Matter to you, the investor, or the user making a decision? If a, rounding error of $5 wouldn't change your mind about buying a multi-billion-dollar company stock, it's probably not material.
Okay, so it has to be significant enough to influence judgment.
Exactly. But if an error changes a reported profit to a loss, that's almost certainly material.
Makes sense. And pervasiveness.
Pervasiveness takes it a step further. It asks, is the effect of this issue widespread across the financial statements?
So not just in one little corner.
Right. Does it represent a substantial proportion of the financials? Or maybe it impacts disclosures that are absolutely fundamental to understanding the overall picture. It's about how deeply the issue affects the overall financial health and transparency, not just one isolated number.
So if I'm understanding this right, there's a kind of decision matrix that auditors use based on these two factors: materiality and pervasiveness.
There is, yeah. It helps guide the type of opinion. If a misstatement is material but not pervasive.
So it matters, but it doesn't wreck the whole picture.
Exactly. That generally leads to a qualified opinion. However, if that misstatement is both material and pervasive.
It matters. Anything messes everything up.
Pretty much. That results in the most severe negative opinion, an adverse opinion.
Ouch.
Yeah. Now, on the other side, if there's a scope limitation, the auditor couldn't get enough evidence, and that limitation is material but not pervasive.
Matters, but maybe they could check other things.
Right. That's also a qualified opinion. But if that scope limitation is material and pervasive, so much so that they really can't form any opinion at all.
They just couldn't see enough.
Correct. That's when you get a disclaimer of opinion.
Okay, let's break down each of these modified opinions then, so we can really grasp their meaning. What does a qualified opinion tell us?
A qualified opinion is the auditor basically saying, look, except for this specific issue we identified, the financial statements are fairly presented.
So, mostly okay, but with a specific but.
Exactly. It's like buying a used car where the mechanic says, everything looks good except for that one tire that looks a bit bald. You'd still consider the car, but you know exactly what needs attention.
Okay, examples.
Sure. For a financial statement issue, maybe a company completely omits a required statement, like the statement of cash flows. Or they value inventory incorrectly, say, at cost instead of the lower of cost or market. If the rest of the financial picture isn't totally distorted, that could lead to a qualified opinion.
And for an audit issue, like a scope limitation?
Yes. Maybe the auditor couldn't physically observe inventory at year-end, but they managed to satisfy themselves through other procedures for most other important areas. It could be qualified then. The key is, it's not so bad that the whole financial statement package is misleading.
Got it. And the adverse opinion, that one sounds pretty serious.
It is. It's the strongest negative opinion an auditor can give. It means the auditor believes the financial statements, taken as a whole, do not present fairly in accordance with the applicable framework.
So fundamentally flawed.
Yes, it's like the mechanic saying, this car's a lemon, don't buy it. It fundamentally doesn't work as advertised.
Wow. Example.
A classic example would be a company's failure to consolidate a significant subsidiary. That's a fundamental departure from GAAP, and its effects are almost certainly material and pervasive. For a public company, getting an adverse opinion is extremely damaging. It signals a major breakdown in financial reporting.
A huge red flag.
Absolutely.
And finally, the disclaimer of opinion. What does that mean for the financial statements?
A disclaimer means the auditor does not express an opinion at all. They're essentially throwing up their hands and saying, we couldn't gather enough evidence to form an opinion one way or the other.
Like the mechanic saying.
I can't even open the hood or get under this car, so I have no idea if it runs or what's wrong with it.
Okay.
This happens when the scope limitation is so severe, material, and pervasive that they just can't reach a conclusion. For instance, if the auditor was hired too late to observe the opening inventory count and couldn't verify it by other means, well, that could prevent them from determining accurate net income and cash flows. That might lead to a disclaimer.
Any other reason for a disclaimer?
Yes, a critical one. If the auditor is not independent. If there's a lack of independence, they must issue a disclaimer, and they have to explicitly state in the report that they are not independent. No opinion can be given.
That's a bright line.
Absolutely.
So we've covered the main opinion types. But even with a clean, unmodified opinion, you mentioned auditors can add extra paragraphs to draw attention to important information.
That's right.
These don't change the opinion itself, but they're absolutely crucial signals for anyone reading the report. What are these called again?
For non-issuers, private companies, we generally refer to these as emphasis of matter and other matter paragraphs.
Okay.
For issuers, public companies, they use similar concepts, often termed explanatory paragraphs.
Gotcha.
They serve slightly different purposes, but the key is neither modifies the auditor's actual opinion. They're like neon signs pointing to something you, the financial statement user, should pay extra attention to.
Okay, let's start with emphasis of matter and those explanatory paragraphs. What kind of information do they highlight?
These paragraphs are used to highlight matters that are already properly presented or disclosed within the financial statements themselves.
So the info is already there.
Yes, it's disclosed correctly, but it's so fundamental that a user really needs to understand it to make sense of the financials. The auditor is just drawing your eye to something important that's already there, making sure you don't miss it.
Okay, like what? Any required uses?
Yeah, there are situations where they have to include one. A common one is when there's been a justified material change in accounting principle. Maybe a company switched its depreciation method. Or if the financial statements are prepared using a special purpose framework, something other than GAAP, the auditor is required to highlight that.
And discretionary uses, when they might add one.
Right, they have judgment here. Maybe there's an unusually important lawsuit with a really uncertain outcome, or a major natural catastrophe that significantly impacted the company after year-end. Significant transactions with related parties could be another.
What about going concern issues?
Good question. If a company has a going concern issue, meaning there's substantial doubt about its ability to continue operating for the next year, but management's plans have successfully alleviated that doubt, and it's all properly disclosed in the notes.
So they address the problem.
Yes, and disclosed it. In that case, the auditor can use an emphasis of matter or explanatory paragraph to draw attention to that note disclosure, even though the opinion remains unmodified.
Okay, so emphasis of matter focuses on something already in the financial statements. What about other matter, or those explanatory paragraphs used for other things?
Right. Those are used for matters not presented or disclosed in the financial statements, but are still relevant to your understanding of the audit itself, or the auditor's responsibilities, or maybe the audit report.
Things outside the financials, but related to the audit.
Exactly. For instance, if the auditor needs to restrict the use of an audit report, maybe it was prepared only for the board and not for general distribution. Or, a really common one, if the financial statements for the prior year were audited by a different accounting firm, what we call a predecessor auditor, and that predecessor's report isn't being reissued with the current report, the current auditor would include an other matter paragraph to explain that situation.
Got it. And what about key audit matters, CAMs, and critical audit matters, CAMs? They sound important and distinct from these other paragraphs.
They are very important and, yes, distinct. This isn't just more jargon. Regulators, especially for public companies, push for CAMs and CAMs to bridge what's called the expectations gap.
Expectations gap.
Yeah, the gap between what users think an audit provides and what it actually does. CAMs and CAMs help you, the investor or user, understand the truly tricky judgment calls auditors have to make, even in a clean audit. It's like shining a light on the audit's toughest challenges.
Okay, so what are key audit matters?
For non-issuers, private companies, key audit matters, or CAMs, are the matters that, in the auditor's judgment, were of most significance in the audit of the current period financial statements. They're selected from matters communicated with the audit committee or those charged with governance.
And non-issuers can choose to report these.
That's right. It's optional unless required by law or regulation. They typically relate to areas with a higher assessed risk of material misstatement, or where significant management judgment was involved, or maybe complex transactions occurred.
So it's optional for non-issuers. What about public companies? Is it mandatory?
For public companies or issuers, reporting critical audit matters, CAMMs, is mandatory in the U.S. if they exist.
Okay, CAM's mandatory.
Yes. These are matters that were communicated or required to be communicated to the audit committee that relate to material accounts or disclosures in the financial statements. And this is key involved, especially challenging, subjective, or complex auditor judgments.
Challenging, subjective, complex judgment.
Exactly. Given the complexity of many public companies, it's actually expected that most issuer audits will have at least one CAM. It really gives you a window into the most difficult areas the auditors grappled with during the audit.
And a key distinction to remember, I assume, is that neither CAMs nor CAMs are used for issues that actually lead to a modified opinion.
Right.
Right, like a qualified or adverse opinion.
That's a fantastic point. Absolutely critical. It really clarifies that CAMs and CAMs are about transparency within an audit that still resulted in an unmodified or unqualified opinion. They're not about signaling something is fundamentally wrong with the financials.
So if there's a qualified opinion, the reason is explained elsewhere.
Precisely. If a matter leads to a modified opinion, whether it's qualified, adverse, or disclaimer, it's addressed directly in the opinion and basis for opinion sections of the report. CAMs and CAMs are for discussing the challenging stuff within an otherwise clean audit outcome. The communication of these matters does not alter the overall opinion.
Transparency, not modification. Got it.
Exactly. Okay, audits aren't always, straightforward gap audits. Sometimes companies use different financial reporting frameworks, especially private ones, or auditors might need to consider information beyond just the core financial statements.
Right. Let's dive into these first, those special purpose frameworks. What are they exactly? And who typically uses them?
Special purpose frameworks are basically alternative sets of accounting rules for preparing financial statements. They're generally used by non-issuers, private companies, not the public ones who typically have to stick to GAAP or IFRS.
Okay, what kinds are there?
Well, there are several recognized ones. Probably the most common you might see is the cash basis.
Just cash in, cash out?
Pretty much, yeah. Tracks receipts and disbursements, often used by very small businesses or maybe some nonprofits. Then there's the tax basis, where the financial statements are prepared using the same rules the company uses to file its income tax return.
Convenient for them, I guess.
It can be. Others are more niche, like a regulatory basis required by a government agency or a contractual basis defined in an agreement. The key is they're all alternatives to the big comprehensive frameworks like GAAP.
So if a company uses one of these, what's the auditor's role? How does that change things?
The auditor needs to first understand the purpose for which these statements are being prepared and who the intended users are. That's crucial. They also need to make sure management includes all the appropriate disclosures for that specific framework. This includes describing the framework itself and, importantly, summarizing how it differs significantly from GAAP.
Transparency again.
Absolutely. And critically, the title of the financial statements must clearly reflect the basis being used. It can't just say balance sheet. It has to say something like statement of assets and liabilities, cash basis.
Makes sense, so users aren't misled.
Exactly.
Now let's talk about other information and supplementary information. They sound similar, but I gather they're distinct things the auditor considers.
They are distinct, yes, and the auditor's responsibility differs for each. Other information is financial or non-financial info that's typically included in an annual report alongside the audited financial statements.
Like the management discussion and analysis, MD&A.
Exactly like the MD&A, or maybe financial highlights, charts, employment data, that sort of thing. The auditor's responsibility here is primarily to read this information.
Just read it. not audit it.
Right. They read it to chat for material inconsistencies between that other information and the audited financial statements, or inconsistencies with knowledge they obtained during the audit. They don't express an opinion or any assurance on the other information itself.
But what if they find an inconsistency?
Good question. If they find a material inconsistency, they need to figure out if the problem is in the audited financial statements or in the other information. If the financial statements need revision and management refuses, the auditor would modify their audit opinion.
Okay.
If the other information needs revision and management refuses, the auditor would communicate that to those in charge, like the audit committee, and potentially add an other matter paragraph to their report describing the inconsistency, or even consider withdrawing from the engagement.
So they don't just ignore it.
Definitely not. Now, supplementary information is a bit different.
Okay, how so?
This is extra detail presented either with or sometimes separate from the main financial statements. Think of detailed schedules like a breakdown of operating expenses by department. An auditor may be specifically engaged to perform procedures and express an opinion on whether this supplementary information is fairly stated in all material respects in relation to the financial statements as a whole.
So a higher level of scrutiny than other information.
Yes, potentially leading to an opinion on that specific info. But this only happens if certain conditions are met. Like, the information has to be derived directly from the underlying accounting records used for the main financials, and the main financial statements themselves need to have received a clean or maybe a qualified opinion.
Wow, so many layers. It really makes you realize how much precision is required and how, a single word or paragraph in that report can carry so much weight.
It really does.
What about subsequent events? Things that happen after the balance sheet date, but before the audit report is actually issued. How do auditors handle those? They seem important.
Subsequent events are absolutely crucial because they can significantly impact the financial statements or the decisions users make based on them. We generally categorize them into two types: recognized and non-recognized.
Okay, recognize first.
Recognized subsequent events provide additional evidence or information about conditions that already existed at the balance sheet date.
So it relates to something that was already going on.
Precisely. These events require adjustments to the financial statements. For example, if a lawsuit arose before year-end and the settlement amount is determined after year-end but before the report is issued, that settlement amount would likely require an adjustment to the liability recorded at year-end.
Another example.
Sure, a major customer files for bankruptcy after year-end. If the conditions leading to that bankruptcy, like their deteriorating financial health, existed before year-end, making the receivable potentially uncollectible at year-end, then that's generally a recognized event requiring an adjustment to the allowance for doubtful accounts.
Got it. Adjustments needed. And non-recognized subsequent events.
These relate to conditions that did not exist at the balance sheet date but arose after that date.
So completely new situations.
Exactly. These do not require adjustment to the financial statements themselves, but they do require disclosure in the notes if they are material, so users aren't misled about the company's current situation.
Examples of non-recognized events.
Think of a major fire destroying a plant or inventory after the year end, or the company making a significant business acquisition after year end, or issuing new stock or debt after year end. These are new events, post-balance sheet. Disclosure, not adjustment.
So the auditor has an active responsibility to look for these events, right? Between the balance sheet date and their report date. Well, what do they actually do?
Yes. During what we call the subsequent period, that time between the balance sheet date and the date of their audit report, auditors are actively performing procedures to identify these events.
Like what?
They'll review things like interim financial statements prepared after year-end, inquire with management, and importantly, the company's legal counsel about litigation, claims, assessments. They'll read minutes of board meetings held after year-end. They'll also specifically ask management for a formal written representation letter confirming that all material subsequent events requiring adjustment or disclosure have been identified and dealt with appropriately.
It's a key final check.
It really is, to ensure the statements are as current and accurate as possible right up to the report date.
And what if something critical comes to light after the report has already been issued and sent out? What's the auditor's obligation then?
That's a tricky situation. Once the report is issued, the auditor generally has no active obligation to make further inquiries or perform procedures.
Okay, so their job is done.
Mostly, but if they become aware of a fact after the report date, which existed at the report date, and which, if known then, might have caused them to change their report, Well, then they do have an obligation.
Ah, okay. What do they have to do?
They need to determine if people are likely still relying on the original report. If so, they must advise the client to immediately disclose the new information and its impact on the financial statements to anyone relying on them.
Advise the client first.
Yes. This could involve issuing revised financial statements with a revised audit report, or making disclosures in upcoming statements, or even notifying regulatory agencies like the SEC if it's a public company. The auditor might dual date their revised report to limit their responsibility just to that specific new piece of information. It would show the original report date plus a later date related only to the subsequent event revision.
And if the client refuses to cooperate, refuses to disclose.
That's a very serious situation. If the client refuses, the auditor must inform the board of directors. And if the board doesn't act appropriately, the auditor must take steps themselves to prevent future reliance on their original report. This could involve notifying the client, regulatory agencies, and potentially anyone known to be relying on the report that the report should no longer be relied upon. It's a last resort, but necessary to protect the public.
Wow, serious implications.
Definitely. Okay, just a couple more advanced scenarios to cover. Let's quickly touch on how opinions are presented when you have multiple periods, like comparative financial statements, and also what happens when other auditors are involved.
Right. How does the auditor's report handle comparative financial statements where you see, say, this year's numbers alongside last year's?
Good question. When comparative financial statements are presented, the auditor's current year report covers all the periods shown. Their opinion applies to each period presented.
Okay. What if their opinion on a prior year changes, maybe due to a restatement or finding an error later?
That can happen. If a prior opinion is updated in the current report, the auditor must explain why. They'll disclose the date of the previous report, the type of opinion previously expressed, the reason for the different opinion now, and the fact that their current opinion on that prior period is different.
Is there an easy way to remember that?
Auditors actually have their own little mnemonic for this, believe it or not. It's called DOR-C. Yes.
Okay.
It stands for date of the previous report, opinion type previously expressed, reason for the prior opinion being different now, changes that have occurred, like the restatement, and a statement that the opinion is different. Helps ensure all the key disclosures are made.
DOR RCS. Got it. Handy. And what if a different auditor, a predecessor auditor, audited the prior period's financial statements? How does the new auditor handle that?
Couple of options. The new auditor, the successor, might arrange for the predecessor auditor to reissue their report on the prior period and include it alongside the successor's report on the current period. The predecessor would typically redate their report to the original date.
Okay. But what if they don't present the predecessor's report?
If the successor auditor doesn't present the predecessor's report, they must make reference to it in their own audit report, usually in an other matter or explanatory paragraph.
What do they say?
They'll state that the prior period financial statements were audited by a predecessor auditor. They'll mention the type of opinion the predecessor issued, unmodified, qualified, etc., and the date of that predecessor's report. However, they generally do not name the predecessor auditor unless the predecessor firm's practice was acquired by or merged with the successor's firm.
So, transparency about the prior audit, but not necessarily naming names.
Exactly.
And the last scenario. What happens when a company has components or subsidiaries that are audited by other accounting firms? You called this group financial statements, right?
Yes, that's common for large, complex entities. You have a group engagement partner at the main audit firm who is responsible for the overall group audit. But parts of the group's subsidiaries, divisions, components might be audited by other firms called component auditors.
So the main auditor relies on the work of these other auditors.
They might, yes. The group engagement partner has to decide whether to even take on the engagement based on their ability to get enough evidence, and then they decide how much work they need to do themselves versus relying on the component auditor. Crucially, they also decide whether or not to make reference to the component auditor in the group audit report.
What happens if they don't reference them?
If the group auditor assumes full responsibility for the work performed by the component auditor, meaning they're satisfied with the component auditor's work and independence, and they've done enough procedures themselves, then no reference is made to the component auditor in the group audit report. The group auditor signs the report as if they did all the work.
Okay. But what if they do want to reference them? If they don't assume full responsibility?
If the group auditor decides not to assume full responsibility for the component auditor's work and instead wants to divide responsibility, they will make reference to the component auditor in their report.
How do they do that?
They will clearly state in the opinion and basis for opinion sections that a portion of the financial statements was audited by other auditors, the component auditors. They will also disclose the magnitude of the portion audited by the component auditor, typically expressing it as the percentage of total assets and total revenues that the component represents.
So it's clear that part of the opinion relies on someone else's work.
Exactly. It provides transparency to you, the user, letting you know that the primary auditor relied significantly on work performed by others for a specific part of the consolidated financial picture. It doesn't lessen the value, but it clarifies who did what.
What an incredible deep dive. Seriously. We've navigated the really intricate world of auditors' reports, from the standard clean opinion all the way to the complex reasons behind modifications and the vital context you get from those additional paragraphs.
Yeah, there's a lot there.
I'm actually starting to see these reports not as dull boilerplate documents, but as incredibly precise financial communication tools. You just need the decoder ring.
That's the perfect way to put it. And the takeaway here really is empowerment. The auditor's report isn't just formalities. It's a critical summary of professional judgment, evidence gathering, and application of standards. Now that you understand the signals from a qualified opinion signaling a specific issue to the subtle alerts in an emphasis of matter paragraph to understanding what a CAM means, you're not just reading a report. You're interpreting a professional assessment that absolutely shapes how you view a company's financial health.
So the next time you see an auditor's report, maybe in an annual report or an investment prospectus, you'll know to look beyond the surface, beyond just the signature.
Absolutely.
We'll be able to spot the green lights, the yellow warnings, and hopefully not too many, but the undeniable red flags. What new insights will you uncover now that you're equipped to decode these essential financial documents?
Stay curious. We'll be back soon with another deep dive.